Okay, Chapter 17, Analysis of Financial Statements. The first 16 chapters were basically designed around the preparers, learning how to prepare the financial statements and all the accounting steps to get there. This chapter is the other side of the equation, and that's the users of these financial statements. So many of you might not want to become accountants or CFOs of companies. However, chances are you will be a user of financial statements, and so I would pay a little bit closer attention to this for your own investment that you might be doing later in your life. So let's get into it. Basics of an, oops, I think I skipped a slide. Maybe not. Basics of analysis tries to reduce uncertainty. There's analytical tools to evaluate this kind of stuff, and it involves transforming data. Again, it's a financial statement analysis that helps users make better decisions. And those users are, again, internal and external. Internal to the company, the managers, the officers, the internal auditors. External users use this: shareholders, lenders, customers, regulatory authorities, taxing authorities. A variety of people will look at this stuff. So these statements are analyzed in quite a bit of detail, especially if you're a publicly traded company here. Some basic analysis of the blocks to analysis is, there's short-term liquidity and efficiency. There can be long-term. Is the company solvent to pay its long-term debts? Is the company profitable? And how does it compare against its competitors, as well as maybe the broad markets in itself? And what's the market prospect going forward, looking forward here? So, information for this analysis. Obviously, the income statement, balance sheet. You do have a statement of stockholders' equity, which we haven't gone into great detail. And, of course, the statement of cash flow, that we finished. And the notes to the financial statements. Generally, the first 4 items there, the income statement, balance sheet, stockholders' equity, statement of cash flows, on an annual report will take 4 to 6 pages long. Notes to the financial pages can be in excess of 100 pages. And part of that reason is because of so many lawsuits, companies are careful to disclose everything, and that disclosure occurs in the notes to the financial statement. And this is what you're going to be studying in intermediate accounting. It's exhausting in its detail. There's also external information. Could be competitor analysis, industry analysis, vendor, supplier relationships, and so forth that sophisticated investors will also analyze here. Standards for comparison. A number by itself is meaningless. You have to compare it to something to get a benchmark of relativity here. And so you're going to compare within the company, within its competitors in industry. There are a variety of guidelines maybe published, as well as broad markets, as well as global perspectives now. The investment world has truly moved into a global arena here. So again, this is used extensively in the investment markets. There's basically 3 tools that you will be studying, and as for analysis, one's called the horizontal analysis, also known as the time analysis. Time is horizontal, so you'll be looking at how the company did from prior periods, whether it be a year ago or 5 years ago, and so forth. Then there's the vertical analysis, based on the base amount. Usually it would be either the income statement or the net gross revenues, or the total assets, and it'll be just looking at the changes from year to year to year over that, and the composition of that income statement and balance sheet. And then there's ratio analysis, and you look at key relations between financial statements and those changes. Horizontal. Again, horizontal is time. Here is an example. They're comparing 2010 to 2011, and then they give you a dollar change and a percentage change. And we can look, for instance, cash is decreasing 18%. yet assets are increasing 15%. And so we'll be looking at where are the major changes, and obviously goodwill and intangible assets, which suggests like maybe a company did an acquisition or something of that nature. So this is one form of analysis, is again the horizontal or time, and it's just comparing different aspects of the balance sheet and income statement over time. Comparative statements, dollar change equals analysis period and amount, and you have some base period. For instance, maybe you'd be comparing it over 5 years. Probably the oldest year would be the base year. And let me see what they're doing. And again, you're doing it both in dollar amount as well as in percentage amount. Most people think the dollar amount maybe is not as important, but the percent is because it's easier to visualize. And again, here they're only doing 2 years, but this time horizon can be 5 or even 10 years out there. So, and if it is, let's say, 5 years out, 2010 to 2014, chances are that 2010 will be a base year, and then every year would be compared to that base year. Again, more changes, both in dollar as well as in percentage change here. Trend analysis is, again, using that time analysis and looking at changes over a period of time. Over there, again, it's another form of horizontal analysis. And here's an example. Now they're getting a longer trend of 5 years, and they're using the 2000, the oldest year, as their base year. And so all these changes would be reflected to the base year. And as you can see, 2009 in sales was a huge drop compared to it was going up, down, and then it resumed its climb. So 2009 was a financial crisis in the world. And then they say a picture's worth 1,000 words. You'll see a lot of graphics put into these analysis, because visually it's just easier to see than to be able to calculate this. So I would recommend trying to use a little bit of this when you do your financial analysis. It does simplify the visualization, and it makes the user more it's more appealing to a user. Vertical, also known as common size statements. And so what you're doing here is you're comparing everything to a base amount in the financial statements. For instance, the balance sheet, you'll use the largest number in each statement. For instance, in the balance sheet, total assets is the largest number, and in income statement, hopefully it's revenues and not losses, but it should be revenues for the income statement. And then everything else will be compared to this number. Let me give you an example here. Again, they're comparing year to year, but they're comparing now how much of cash is compared to the total asset, is a makeup of this. So now we're analyzing this balance sheet, and we can see changes from one year to us. The cash went down this year and so forth. Whereas this number is not the same, the percentage is on a comparative basis here. So here we're seeing the composition of the balance sheet, and how that composition changes. It can be very insightful of what's going on in the company here. Again, and they're going to be doing this also for the income statement. And then you're taking the biggest number, hopefully sales, and you're comparing everything to that. And you can go right to the bottom line and sort of say, wow, their net income after taxes, they went from 7.4% to 8.6%, a nice percentage increase. So what they're saying here in 2011, for every dollar in sale, they're making 8.6 cents in net profit. And then we'll look at the variety of categories. And this common size statement, there's a couple of advantages to it. Number one, you can compare companies of different sizes. And it gives it some relevance to this. Also, managers will look at this and look at their departments on the same basis to be able to judge that. So this is used extensively. Again, common size graphics, putting things into a graphic form is visually very appealing to users. Okay, I'm going to stop here and start another video.